To keep yourself updated, subscribe to Indigo Learn and click the bell icon and download our app OneFin to start learning on the go.
Let's now talk about measurement after recognition. This is also referred to as subsequent measurement. That is to say, at each balance sheet date, how will we measure the property, plant and equipment? Now, the standard prescribes two models, cost model and revaluation model. Cost model is something which you would have learned right from the time when you started learning accounting. So, under the cost model, you take the cost of PPE. From that, you will reduce accumulated depreciation, and from that, you will also reduce accumulated impairment losses. Now, what is impairment? We will understand in Ind AS 36. Just for the sake of clarity, an impairment loss occurs when the carrying amount of that asset is less than the benefit that you will get from that asset. Now, there are some technical terms used which we will understand in Ind AS 36. For now, understand that if the carrying amount is, let us say, 1000 and the benefit that the entity expects to get from that asset is only 800, the difference of 200 is impairment loss, right? In a very simplistic term. So, you will take the cost, from that you will reduce the accumulated depreciation and accumulated impairment losses. Whatever you get is the carrying amount. In fact, we have solved problems where we have reduced the accumulated depreciation from the original cost, and the amount that you arrive by deducting accumulated depreciation from the cost of PPE is the carrying amount of the asset, right? So, you will take cost minus accumulated depreciation minus accumulated impairment losses. This is one model which is largely followed. The other model is the revaluation model. Now, why do we need this revaluation model? Let's take one example. Say an entity purchased land some 20 years back at 20 lakhs. So, some 20 years back they have purchased a piece of land at 20 lakhs. Now, if you check the value of the land today, if you go to the market and find out how much will that land cost, the current market value is, let's say, 1 crore. You purchased at 20 lakhs, but right now the value of the land is 1 crore. Now, do you think the balance sheet is giving a fair picture? Something which has a worth of 1 crore, you are showing it in the books of accounts at 20 lakhs only. Now, because it is land, it is not depreciable, so you will continue to carry it at cost, which is 20 lakhs. Now, this kind of treatment may not give a fair picture of the financials, and hence Ind AS 16 prescribes another model which is the revaluation model. Now, what would we do under revaluation model? 20 lakhs was the cost, current value is 1 crore. We will understand how do we arrive at those values. Current value is 1 crore. Increase the value of land in the books from 20 lakhs to 1 crore. So, originally the asset was at 20 lakhs. Now, after revaluation, the asset will be shown at 1 crore. We have increased the value of asset by 80 lakhs. Now, if you have increased the asset value by 80 lakhs, we should also increase some portion on the equity and liability side. So, that increase, whatever is the increase in value, that 80 lakhs will be shown under revaluation surplus under other comprehensive income. You will not take it to the P&L. There are methods of arriving at this number, we will come to that, but for now understand that under the revaluation model, you are allowed to bring the value of the asset at its fair value. Wherever you can derive the fair value, wherever you can determine the fair value, you can measure the property, plant and equipment at fair value. Now, once you have measured at fair value, on this value, you will start charging depreciation. We will come to all of those discussions. So, two models. First is the cost model, where you will take the cost, less accumulated depreciation and less accumulated impairment losses. And the next model is the revaluation model, where you will take the fair value of PPE, less accumulated depreciation subsequent to revaluation and accumulated impairment losses subsequent to revaluation. So, these are the two broad models which are prescribed by Ind AS 16. Entity can either choose the cost model or the revaluation model. Now, the cost model is a simple one, right? You just need to calculate the cost, the depreciation and the impairment. When it comes to revaluation, we are saying we need to compute the fair value of that asset. Now, the first question is, how often should we compute the fair value? Should we do it every year? Should we do it every 2 years, 5 years? How often should be the frequency of revaluation? For this, we have to look at the changes in the fair value of that particular asset. Now, to determine the frequency of revaluation of assets, we have to check the volatility in the asset's fair value. Does the asset value fluctuate? Is it highly volatile? If that is the case, then the fair value must be computed annually. But if the fair value of that asset is pretty stable and it does not fluctuate highly, it is not very volatile, then the entity may choose to do it maybe once in 3 years or 5 years or 2 years. purely depending at the entity's discretion. But if the value changes frequently, the asset value itself is volatile, it keeps on fluctuating, then you have to do annual revaluation. That is the first thing. So frequency, if it is highly volatile, then do it annually. If it is not volatile, if the changes are not significant, if the changes are not material, then you can do it once in 3 years or 5 years. Then the second question is, can we choose cost model for one asset and revaluation model for another asset? Because what entities would want to do? They would be smart. They want to take benefit on both the sides. Say for example, there are two assets. Let's say there are two land and buildings. Both were purchased at 1 crore at different locations, right? This is location A, this is location B. After few years, the value of this property at location B increases to 5 crores. But when it comes to location A, the expected developments did not happen and the value of that asset has actually come down to, let us say, 80 lakhs, right? So here 1 crore to 5 crores, here 1 crore to 80 lakhs. Can the entity say, for this asset, because the value has increased, we will apply the revaluation model, whereas for this asset, where the value has come down, we will apply the cost model. Or the company may also want to choose vice versa, that is, where the value has come down, let us show losses, and where the value has gone up, let us ignore that. Now for this, the standard clearly prescribes that if you are revaluing one asset of a particular class, then all the asset in that class should be revalued. That is to say, if you are revaluing land and building at location B, then you should compulsorily revalue land and buildings in location A as well. Which means, if you are revaluing land and building at location B, you also need to revalue land and buildings at location A. You cannot pick and choose and revalue only selective assets. So, you have to revalue all the assets within a class. Now, the company may also have plant and machinery. Now, if you are revaluing land and buildings, is it necessary that we revalue plant and machinery as well? It is not required. Within the class, if you are revaluing one asset, all the assets in that class should be revalued. A different class of asset may be carried at cost model. So, the entity can choose to apply cost model or revaluation model to a specific class. Say for example, you have 10 classes, class 1 to class 10, and each student represents an asset. So, if you are applying revaluation model to one student of class 1, you have to apply revaluation model to all the students of class 1. You can ignore class 2 to class 10. Now, let us say for class 9, for one asset you have applied the cost model. You have to apply cost model for all the students in class 9, right? For all the assets falling in a class of asset, you will need to apply a model consistently. Apply cost model for all or apply revaluation model for all. But you cannot be partial and only revalue few assets in a class and ignore the other assets of the class. Now, what do we mean by a class of assets? Class of assets basically mean assets which are similar, which are of similar use to the entity. For example, land and buildings. Land and buildings at different location, they are a same class of asset. Then you can talk about, let's say, office equipment. You can talk about vehicles. You can talk about ships. You can talk about bearer plants. So, a group of assets which are similar in nature and which are of similar use to the entity are called class of assets. Index 16 gives an illustrative list of class of assets. So, you can have land and building, machinery, ships, aircraft, motor vehicles, furniture and fixtures, office equipment, bearer plants. This is just an indicative list. So, if you are talking about furniture and fixtures, all item of furnitures would fall under the class of furniture and fixtures. All item of office equipments, maybe your air conditioning equipment or any other electrical equipment, that could fall under office equipment. Then you have vehicles, then you have land and building. See the distinction, land is separate, land and building is separate. Now, if you are applying revaluation model to any one asset in any of the class of assets, then you have to revalue the entire class of assets. Now, why am I re-emphasizing this? Because this is one tricky point where you can get a question in the examination. So, to quickly summarize, subsequent measurement can be done using the cost model or the revaluation model. If you are using the revaluation model, what should be the frequency? If the changes to fair value are not significant, then it can be done once in 3 years or 5 years. If the changes to fair value are significant, if the asset experiences volatile changes in the fair value, then it has to be done on an annual basis. And coming to application of revaluation model or cost model, for a class of asset, you cannot apply both the models. If one item in a particular class has been measured using, let's say, cost model, all the items in that class should be measured using cost model. Similarly, if one item is valued using the revaluation model, all the items in that class of asset should be measured using revaluation model. Now, whenever we revalue an asset, whatever surplus is generated, because we are increasing the value of an asset, that surplus is shown under revaluation surplus under other comprehensive income. You cannot take it to P&L, you cannot take it to retained earnings directly. It has to be shown under revaluation surplus. And the reason why we keep it separately under revaluation surplus is we cannot pay dividend out of this surplus. See, you have just increased the value of the asset. You increase the value of asset from 20 lakhs to 1 crore. Now that 80 lakhs of revaluation surplus is a kind of gain, but that gain is not yet realized and you should not be allowed to pay dividend out of that gain, and hence we show it under revaluation surplus under other comprehensive income. Now, can we issue bonus share out of this revaluation surplus? We cannot even issue bonus shares out of revaluation surplus because it is neither a free reserve, it is neither a part of your securities premium account, it is neither a part of your CRR, right? So, because it doesn't fall in any of these three categories, you cannot use revaluation surplus to issue bonus shares. Let's take one more example to understand the class of assets things much better. Say there is a company, the company owns factory buildings and warehouses, and the company also owns office buildings. So, you have factory buildings, warehouse buildings and office buildings, and these are located at different parts of the country. Now, what the company wants to do is, it wants to apply the revaluation model to the office buildings, but it wants to carry the factory buildings and the warehouse building using the cost model. So, for one kind of buildings, it wants to apply revaluation model. For other kind of buildings, it wants to apply the cost model. Is that permissible? Now, just because we said that buildings form a single class of asset doesn't mean that the office buildings and the factory buildings are also same class of asset, because the use are different. How did we understand a class of assets? Assets which are similar, both of them are buildings, but are they of similar use? Are they of the same use to the entity's operations? No. Factory building, warehouse buildings are used for different purposes, office buildings are used for different purposes. So, what you can do is, you can call office building as a separate class of asset, and you can call these factory buildings and warehouse buildings as separate class of asset, and apply revaluation model to the office buildings and use the cost model for the factory buildings and warehouse buildings. Let's now understand the accounting aspects under revaluation model. Whenever we are valuing an asset under the revaluation model, what are we doing? We are calculating the fair value, we are arriving at the fair value, comparing that with the carrying amount. Now, the fair value may be higher than the carrying amount, the fair value may be lower than the carrying amount, right? Now, in each of these scenario, how do we do the accounting? How do we take care of the depreciation aspect? What do we do with the accumulated depreciation? All of those things is what we will be understanding now. Say for example, we have an asset with original cost of 1 lakh. The useful life is expected to be 10 years and with no residual value, and we are following the SLM method of depreciation. So, every year the entity would charge 10,000 as depreciation to the statement of profit or loss. Now, at the end of 4 years, the entity wants to apply the fair value model, right? So, let us see how does it work out. Now, the original cost is 1 lakh and we are doing it after 4 years. So, we have to calculate depreciation for 4 years. How much will that be? 1 lakh divided by 10 multiplied by 4. So, 40,000 is the depreciation. This we call accumulated depreciation, accumulated depreciation. Then we calculate something called the carrying amount. What is the carrying amount? The cost of 1 lakh minus depreciation of 40,000, 60,000 is the carrying amount. Now, in the balance sheet also, I am preparing a T-shape balance sheet for our understanding. In the balance sheet also, you will have PPE cost of 1 lakh plus accumulated depreciation of 40,000 right. So, carrying amount would be 1 lakh minus 40,000, that is 60,000. Now, in the books, in the balance sheet, you can see that the carrying amount of this asset is 60,000, right? Gross block or the original cost 1 lakh, accumulated depreciation 40,000, carrying amount 60,000. Now, in the books of accounts also, you will have a separate ledger for the cost of the machine. You will carry the machinery at cost in a separate ledger, and accumulated depreciation will be in a separate ledger. So, how it would appear is, the PPE would appear in year 1, you would have passed the entry to, let us say, bank. You would have passed the entry to bank 1 lakh, right? And every year you will carry the balance forward and show PPE at cost of 1 lakh, and accumulated depreciation every year, year 1 to year 4 will be by depreciation. So, basically the entry will be depreciation account debit to accumulated depreciation. You will have 10,000 into 4, which is 40,000. So, original cost of PPE 1 lakh, and it will continue to be shown as 1 lakh in the books, and accumulated depreciation every year you will charge 10,000. So, the accumulated depreciation will be 40,000. This is the presentation part. This is purely the presentation part. But we know that the current value of this PPE as per the books, the carrying amount of the PPE as per the books is 60,000 only. How do we get the 60,000? 1 lakh minus 40,000, we get 60,000. Now, assume for a moment that the fair value on this date it has increased and it is 80,000. The fair value has increased and now it is 80,000. Now, the question is, how should we bring this 60,000 to 80,000? Carrying amount is 60,000. We have to bring it up to 80,000. How can we do that? Now, for this, there are two approaches. The first approach is eliminate the depreciation, bring the depreciation account to 0 so that this PPE comes back to 60,000. What do I mean by that? This depreciation balance is there, right? 40,000 in the accumulated depreciation account. This, you transfer it to the PPE account and make the PPE account equal to the carrying amount. So, what we will do is, from here at the end of year 4, we will say to PPE account, that is 40,000. We will transfer this 40,000 from this account and we will bring it to the PPE account by accumulated depreciation 40,000. Now, once we do this, what happens? Our balance will be 1 lakh minus 40,000, 60,000 will be the balance. So, indirectly we know that it is already at 60,000, but we are showing it in two different ledgers. So, the first thing that you will do is, you will eliminate the depreciation and transfer the depreciation to the PPE account and bring the PPE account from cost to the carrying amount. Right? So, this balance becomes 60,000, which is nothing but this carrying amount of 60,000. Now, we know that the balance is 60,000. We know now the balance is 60,000 and we have to increase that to 80,000. What is the increase? Increase is 80,000 minus 60,000, 20,000 is the increase. So, what you do is, in this PPE account, end of year 4, you say to revaluation surplus. You are increasing the value of PPE. You are adding 20,000 to the value of PPE. You will debit the PPE account and you will credit the revaluation surplus. This revaluation surplus will be shown under other comprehensive income under equity. How much is the revaluation surplus? 20,000. So, you debit the PPE account and you credit the revaluation surplus by 20,000. Now, the balance, the revised balance of your property, plant and equipment will be 1 lakh plus 20,000 minus 40,000. 1 lakh plus 20,000, 1 lakh 20 minus 40,000, 80,000 will be the balance carried down, right. So, what did we do? We increased this value of property, plant and equipment from 60,000 to 80,000. So, now after revaluation, PPE, the carrying amount is now 80,000 and revaluation surplus is 20,000. See, in net effect, here also the net asset side was 60,000. Assume here we have other liabilities and equity 60,000, assuming that these two are only the items in the financial statements, right? Now, here you will have other liabilities and equity 60,000, revaluation surplus I am showing it separately 20,000. So, 60 plus 20 80, and this side also 60 plus 20 80,000. So, this is one approach to apply the revaluation model. What did we do here? First step, transfer the balance of depreciation to the PPE account. Then calculate the amount of revaluation. Then debit the PPE account with the upward revaluation and credit revaluation surplus with the increase in value of PPE. So, what would be the journal entries if you take it one by one? First entry what we did was we transferred the accumulated depreciation to PPE account. So, the first entry would be PPE accumulated depreciation account debit by how much? By 40,000 to PPE account 40,000, right? So, this is the first. So, this is the first entry. Then second entry. What is the increase in the value of PPE? How much is the difference between the fair value and the carrying amount? PPE account debit 20,000 to revaluation surplus 20,000, right? Now, how do we charge subsequent depreciation? We will charge on this value of 80,000. So, not 60,000, but now on 80,000 we will charge the depreciation. We will come to that in some time. So, I hope you are clear with the first way of treatment at the time of revaluation. Now, under the first method, we eliminated depreciation, right? So, we made accumulated depreciation to 0 and then did the revaluation. Under the second method, what we do is, we do not eliminate the depreciation, but we increase the gross amount of the asset as well as the accumulated depreciation proportionately to bring the asset value to the fair value. Now, what do I mean by that? See, the fair value of that asset is 80,000. The fair value of that asset is 80,000. What is the current carrying amount? Current carrying amount is 60,000. From that 60,000, we have increased the value by 20,000, correct? So, instead of just doing a net basis accounting, we will do a gross basis accounting. So, what do we do here? We will first compute what is the increase percentage. What is the increase percentage? Increase percentage is nothing but 20,000 divided by 60,000 multiplied by 100, right? So, that comes to 0.33. I will convert this into percentage. It comes to 33%. So, 20,000 divided by 60,000 multiplied by 100 comes to 33.33%. What are we doing here? We are increasing the carrying amount of the asset by 33.33%. Now, can I say that I can increase the cost by 33.33% and also increase the accumulated depreciation by 33.33%, correct? So, I am increasing both the cost as well as the depreciation by the same proportion to ensure that this carrying amount increases from 60,000 to 80,000, which is also by 33.33%. I am repeating once again. The net increase in the carrying amount is 33.33%, that is 60,000 has to become 80,000. Now, instead of just increasing this 60,000 to 80,000, what I am doing is I am increasing the overall cost by 33.33% and also the accumulated depreciation by 33.33% to ensure that the net carrying amount is also increased by 33.33%. So, now what we can do? We can increase that. Increase what? Increase the original cost, that is the gross carrying amount, by 33.33%. So, 1 lakh into 33.33%, that comes to 33,333.33, and depreciation by 4 lakhs multiplied by 33.33%, that comes to 13,333.33. So, I am actually increasing this, I am actually increasing these respective amounts. So, what is my revalued amount? my revalued amount is 1 lakh plus 33,333 and 40,000 plus 13,333. If you see the carrying amount, this minus this, it becomes 80,000. So, the increase is this multiplied by 33.33%, that is 20,000. So, what did we do? We increased the original gross value by 33.33%. We increased the accumulated depreciation by 33.33%, which resulted in increase in carrying amount by 33.33%. So, when you present it in the balance sheet now, PPE gross amount would be 133,333. Accumulated depreciation would be 53,333. Accumulated depreciation would be 53,333. Carrying amount would be 133 minus 53, that is 80,000. So, between the previous calculation here, also the carrying amount is 80,000 after revaluation, but we are showing that as a single component, whereas in this method we are increasing the gross amount as well as the accumulated depreciation to arrive at the carrying amount of 80,000. Now, in the second approach where we are not eliminating the depreciation, we will not pass the depreciation entry. We will not transfer the depreciation to PPE account, but instead we will increase the depreciation amount. We will increase the depreciation amount as well as the PPE amount, So, first let us look at the journal entry that we will be passing. You have increased the PPE, so PPE account debit by how much? By 33,333. We have increased the accumulated depreciation, so to accumulated depreciation by 13,333 to revaluation surplus. The difference of these two, 33 minus 13, it comes to 20,000, right? So, I just make the formatting consistent. So, increase PPE by 33,333, increase accumulated depreciation by 13,333 and balance goes to revaluation surplus. Now, what will be the entry? Here in the accumulated depreciation account, we have increased it by 13,333. So, you would say by PPE account 13,333 and to balance carried down would be the opening depreciation value plus 13,333, which makes it 53,333. This you can see here in the balance sheet, and PPE account debit by 33,333. So, in the PPE account you will have to revaluation surplus 20,000, to accumulated depreciation 13,003. In accumulated depreciation, you will have 13,333.33 and the balance carried down would be 1 lakh plus 20,000 plus 13,333, which makes it 133,333. So, you can see this linkage. So, you can see this balance of 133,333 is being shown here and this balance of accumulated depreciation is being shown here. Net of these two, the revised carrying amount is 80,000. The carrying amount remains the same. In the first method, you have eliminated the depreciation. In the second method, you have increased both the gross carrying amount as well as the accumulated depreciation.